In this section of the discussion we're having about intermarket analysis between notes, so for example, we have the 10-year yield index right here for the 10-year note versus currency pairs such as the dollar yen or the dollar franc. We're going to be looking at very specifics as to, well, what are a few methods that we could use to analyze these markets, to try to infer either trading signals, risk indications, so what's going on with risk out there from one market to the next, because it can actually be very helpful and can help us make decisions. That's really one of the key factors here, is that we want to be able to make the right decisions with as much information as we can. Now, fortunately, there are no perfect correlations in the Forex. If there were, we wouldn't be able to do this kind of analysis. But the correlation that is imperfect, but it does exist and that we're using here, is more or less just trying to track what's going on with capital flows. So for example, the 10-year yield, if it's rising, that means that yields on the 10-year note are rising. That generally means that yields in the market, in the US markets, are going up. Well, what happens is that capital will then flow from low yields to high yields. Well, currently, two of the lowest yielding currencies out there are the yen. So if we were to see the TNX start to really move to the upside, we would expect to see the yen begin to weaken and trend up. So the dollar yen, because the dollar would be gaining strength against the yen. Well, the same thing is also true of the franc. So the franc is also another very low yielding currency currently. And if we were to see yields in the US start to rise, we would see the franc start to weaken. Well, the converse is also true. If yields are beginning to drop, so as we can see here on TNX, from June through the middle of July, we've got yields dropping in the US, and you can see very similar behavior here on the dollar yen as the yen begins to gain a little bit of strength through right now. What's really affecting that is a bit of a short squeeze, and the franc gains a little bit of strength as it acts as a defensive shelter when there's problems in the US. So we can watch this seesaw of capital flows shifting from the US into other currencies, and we can boil this down approximately into just what's the balances between the two yields. Now, timing a trade is where we can start to dig into a little technical analysis. So looking at the flow of capitals is almost we're almost looking at the opportunity from a fundamental perspective when we think about flow of capital, but it helps us understand what's going on. Intermarket analysis is very tied in with technical analysis. Let me show you a couple of examples. This is by no means comprehensive of the kinds of things that we can do in intermarket analysis using technical analysis, but it is a good example of a couple of things that we can do to try to transfer signals that we're seeing in one market, in this case the 10-year yield, into other markets to make trades or to manage risk. Now, I'm a big candlestick fan. I like candlestick analysis because there isn't much of a lag, and the signals are fairly clear, and I found them to be quite helpful, especially when not necessarily timing trades, the entries, but perhaps exits, but certainly risk coverage. They're very good risk indicators, and let me give you a good example. So right now on the TNX, we've had over the last few weeks, we've had a little bit of a rally to the upside. That means that yields are on the rise. Subsequently, on the 23rd of July, we had this funny little candlestick here up here with a couple of shadows above and below a very small body. In fact, there's almost no body, meaning that the market closed virtually where it opened. Then the next day, on the 24th, we get a big move to the downside. Yields really dropped. Well, from a candlestick analyst's perspective, this is a borderline abandoned baby, but we'll actually get back to that here in a minute. This is technically an evening star. What that means is that there was a run-up, and then kind of this gap to a doji. That's what this kind of candle is called. And then a big gap down where the subsequent day moved down at least below the midpoint of the previous run-up. So the 22nd and we want to see the candle on the 24th of July be lower than the midpoint of the candle on the 22nd. So that is a very bearish signal. Well, how might I use this information? Well, let's take a look at one of these currency pairs. So using a very personal example, currently I'm long the dollar yen. I was using some intermarket analysis, speaking of which, to time a trade that really nailed the bottom of the market. It was I was a very fortunate trader to be able to get in here at virtually the bottom of the trend and have been riding this to the top. Now, I'd kind of anticipated that there was a good chance this might be a short-term trade as we approached the highs of June. So I thought, this might be acting as resistance. We had a real serious consolidation there, and now the market is creeping up on that level. It's within about 20 pips or so of the majority of the price action in this consolidation. So I'm using this information here on the TNX, or the 10-year yield, to say we have a very bearish indicator on the 10-year yield at the same time that I'm hitting resistance on the dollar yen. In fact, we can zoom out a little bit and get an even better view of exactly what am I talking about. Well, boom. I mean, this is a fairly significant resistance area. So what kinds of things could I do? Well, there's a number of things that I can do. Everything from buying a put on the dollar yen to protect myself to the downside, to even just exiting the position and moving on to find another opportunity, despite the fact that there was a fairly short-term move that I was taking advantage of. But in either case, the conclusion that I can draw is that there's a fairly high level of risk, and that I should act appropriately. I don't need to act like I was back here in the middle of the trend a week ago versus now that I have more information here at the top of the trend. I've zoomed out a little bit on the TNX to show a couple of another example. I mentioned earlier that about an abandoned baby. These are really interesting candlestick patterns, and if you're a candlestick analyst, you know that they're extremely rare. Well, check this out. This is really interesting. What happens is that the market gaps down. This generally happens at the bottom of a trend, which you can see here, or at the top of the trend. It's a very significant reversal signal. So on the 31st of March, we get this doji that appears, and then subsequently the market gaps up, and there's no connection, no overlap between the shadows and the candles or anything. There's a gap up on the 1st of April. This is a very, very bullish signal. So this is something that we look at as an opportunity to either cover a short trade potentially, or to start evaluating long opportunities. Well, what this means is, so this bullish opportunity is indicating that there is a very high probability that yields are going to rise, which subsequently is exactly what happened. Well, let's take a look at our other currency pair and see what was going on when that occurred. Well, not surprisingly, we see that flow of capital shift, and as yields on the 10-year took off on the 1st of April, we see a big candle to the upside on the dollar franc. But this is not just a one-day signal. An abandoned baby like that is a reversal signal. If it's confirmed with the market subsequently moving to the upside, is a really big deal. So it's a strong reversal signal and indicates that there is a nice opportunity to the upside here. So what we could infer from this is that, number one, is that support has been established, which if we draw a line across the bottoms that had appeared earlier in March, and then subsequently that one that appeared as the abandoned baby appeared on the yield index, you can see that that support level was respected again as the market consolidated a little bit through April, and then boom, popped up 500 pips. So that was a great opportunity. Interestingly, in fact, we could have targeted this upside pretty simply by, if we scan out here just a little bit, we can see where resistance was and where we might have started to target the upside on such a strong reversal signal. I've redrawn a resistance level that's been in play for quite some time. If we scroll out here a little bit, you can see this has been in play as a transition or an inflection point over the last more than a year or so. In fact, it's currently a resistance level we're watching very carefully to see if the break that's happening right now is anything more than just nosing through the fence, if you will. So we're watching that closely, but it would have been a nice target to look for on that reversal signal. So two candlestick methods to look for opportunities from one market to the other, but we can also use technical indicators in a very similar fashion. In fact, using technical indicators in intermarket analysis is something that I really like because it does help. By blending it with intermarket analysis, we can eliminate some of the lag that exists with with a lot of technical indicators, and that's what we're going to be moving to next. Now, spending a little bit of time on the analysis of finding intermarket opportunities is useful here because it's a principle. These are principles that we're going to be using whether we're talking about yields and the Swiss franc and the dollar yen, or gold and the Aussie, or oil and the Kiwi and the Canadian dollar, or some of these currency pairs and their intermarket counterparts that we're going to be looking at in the future. These are all methods that we can begin to put into our arsenal to be using in any intermarket relationship where we're trying to find exit signals or entry opportunities.